Hey, what's up YouTube, and welcome to a very special giveaway episode where we're giving away part one of our institutional market maker strategy to help you identify market maker order blocks. And throughout the course of the video, we'll also be referring back to this PDF document, which we'll make available to you guys free of charge. We'll copy a link in the description. As soon as we get to 50 likes, we'll post a link to that PDF. And also when we get to 100, we'll post part two of our institutional strategy video free of charge on YouTube. Just for context, our strategy is part of the bonus content of our trading education course. The link is also in the description for those interested. It's split over 10 lessons, 2 hours of content suitable for Forex, stocks, commodities, and crypto. But in particular, this strategy and this PDF and this video that you'll be watching right now is mainly focused on Forex, okay? Forex is widely known as one of the most liquid and heavily manipulated markets, and in this video we'll explain several concepts which hopefully give you an idea of why the markets move in the way they have to in order to benefit the key market participants, which will ultimately always be banks and financial institutions, okay? Retail traders will often always be the liquidity on the wrong side of the trade. Okay, so the number one concept, just to get right in our minds before we can achieve anything in terms of aims and outcomes out of this video, is to understand one, what moves the market, and two, who are banks and institutions and why do they exist, okay? So number one, the markets move because of liquidity. The market doesn't move because of supply or resistance zones, as you can see here. It's really, really important, guys, to recognize that the market doesn't see your trend lines, it doesn't see your support or resistance zones, it just sees price and liquidity, okay? And what we mean by liquidity is orders, and quite often it's the stop orders of retail traders. The job of banks and financial institutions, you've got banks, you've got hedge funds, you've got other FIs who need to transact in the Forex market, either to execute orders that they have or simply to speculate and profit, is to stack orders, okay? Order blocks is basically the stacking of buy or sell orders by banks or financial institutions. If we flip back to our PDF strategy notes, and we'll just go through some of the hard truths for Forex traders, okay? Banks and financial institutions move the market via their liquidity, and you've got to follow it. Otherwise, you end up being the liquidity. And liquidity is, I guess, the lifeblood of the market, as we've mentioned, and it is the constant flux of the market and how it works each and every day. And your job as a trader is to identify imbalances in supply and demand, and these are certain zones basically that give you the opportunity to jump in the trade to ride the wave along with the market makers who have the liquidity in the market to move the markets, okay? So let's set the scene in terms of this diagram and what it is trying to explain. We've got a period of consolidation, which we can see quite clearly. We can see the line spiking in and out. We can see a bit of a spike up here. This would have probably have caused a retail buying frenzy, and guess what? They would have been swiftly stopped out. And what you can see here, quite importantly, is a break below this zone, okay, and a retest. This is, I describe as the baby pip strategy. And as you can see, in terms of the break and close and the retest, you would have got retail traders selling, okay? Let's say a retail trader would have put their stop somewhere around here. They probably would have been targeting at least 3, hopefully, if not 4, in terms of risk to reward. And if they didn't move their stops in time, they would have been liquidated, okay? So we've just seen a scenario where a retail trader was temporarily on the right side of the market and they got liquidated. Let's think about the other people who would have been buying, okay? The people here who would have been buying, the people here who would have been buying, because the retail mindset is that the more time support is tested, the stronger it is, when in reality, the more times price revisits a certain zone, the more orders are executed, and therefore the order block or remaining order block is much lighter, okay? And that means price can easily go through. That's sometimes why you have flash crashes in the market, because you have a huge imbalance in supply and demand. It's really important that you understand that concept, that support is not made more stronger just because the market has got there more times. It's completely the wrong way to look at it, okay? So let's imagine a scenario where you've got a retail trader right here. They're looking at a buy order. They always put their stops very tight, okay? Let's say they put their stops here, which aligns with the red zone there. They would have been expecting a retest here, and maybe they would have cloned this zone and also potentially have been expecting an extension of somewhere up here. Okay, a pretty decent risk reward. In reality, what happens is the market flushed them out, and what we need to realize in terms of retail buy stop orders is that they are sell orders. Okay, and what I mean by that is when they get liquidated, in order for the retail buyer to get out of their buy position, they must sell. Okay, they must do the opposite of what they did originally, and that simply gives more fuel for the market makers here. Okay, so here we are on the 1 hourly chart, and what we can see is we had a nice structure created by this bullish pin bar. Retail traders would have been trading this on the way up, and what we can see here is a nice bullish engulfing, and of course another retest right here. And according to the retail mindset, of course, the more time support is tested, the stronger it is, and therefore we should get in huge buy opportunities. Okay, that's the retail trader mindset. Let's see exactly what the market did. So the market came down, and we'll pause it right here and let's just identify what's happening. Okay, we're at a key macro zone, okay, for EURUSD. We're expecting market manipulation. We're expecting the market maker to need liquidity to slowly stack buy orders, and what they do not want to do is execute in inferior prices. Okay, so if X marks a spot right up here, this is the zone that market makers do not want to be buying. They do not want to be buying at these prices in the 113s. They want to be buying in the low 112s. Okay, so let's see what the market does, and according to our strategy, what we expect to happen. So let's just pause it right here. Okay, so as you can see here, the market came down, okay, liquidating retail buyers, and we'll just show you exactly what we mean. Retail buyers would probably have been looking for a retest of this structure up here. Their stops would probably have been below this low right here, and as you can see, it got liquidated. Okay, it just didn't have a chance. And what we can see, the market came down, and right here you can start sort of see momentum and the stacking of orders. Okay, there's lots of different ways to conceptualize and look at lower time frames. You can look at momentum, you can look at consolidation, you can use trend lines, you can use Fibonacci, you can use Wyckoff, you can use lots of different concepts and themes, shall I say, to look at the price action on the lower time frames to tell you exactly what's going on. But as you can see, the market went up. Okay, it broke this zone, it went right up in the zone, it retested and continued upwards. And as we know, okay, so now we know that market makers have liquidated the buyers and they're in huge sell positions. Okay, they've pushed the market lower by entering sell positions, and let's see exactly what the market does. The market pushes up, it breaks this zone, it tests the top of the structure. Okay, again, potentially trapping more retail traders there who were buying on the break and close or the break above. Okay, simple support and resistance traders, and it's around here that we picked up our order. Okay, the market is often imperfect. Okay, you can see down here it would have been I guess a valid place to enter. There's two reasons why we didn't enter. Number one, look at the size of that bullish engulfing candle. Only a market maker can do that. You're looking for better confirmation before entering the market. So this is where we were buying around the halfway mark of the zone, because we know that market makers are closing their sell positions. So we took the trade on the 1 hourly time frame. Let's have a look at the 4-hour chart just to see how the market evolved. The market had done what it needed to do. It spiked up. Our stops were safely below, okay, the low, just to be extra safe, and the market went up. And you can sort of see these consolidation periods happen whereby markets are stacking buy and sell orders, and this is where the market is currently. Okay, it's way up here. And just finally, just recapping, I guess, in terms of risk to reward, where you'd put your stops. You can put your stops sometimes very, very tight here, but it would have hit us for break even, and we knew this was a key daily position where the market was going to make a decision about whether to go up. Okay, so we were looking at TP1 at a risk to reward of around about 3. TP2 has been hit. Okay, that was a risk to reward of 4, and TP3 will hopefully be hit later this week at a risk to reward of just under 6. Okay, and going back to our PDF guide, okay, we've included within here lots of commentary and also a guideline in terms of what needs to happen for the rules to work, and also giving you the illustrative example that we've just gone through now, and also a recap right here of our take profit targets. Okay guys, so that was part 1 of our institutional market maker strategy. As mentioned, when we get to 50 likes, we'll drop a link to this PDF guide. And when we hit 100 likes, we'll share part 2 of our institutional trading strategy, which will break down the following trade that you can see on screen, a sell that we took on USD CAD recently. Okay, had a brilliant risk to reward of just over 9. It's quite rare really to get a risk to reward in excess of 9, but following our strategy we could achieve this. Okay, and we're expecting at the very least potentially a retest on 123.2 before looking at the next move of the market. So I hope you enjoyed the video. It's part of our trading education series here on our YouTube channel, Figuring Out Finance. If you haven't already, please hit that subscribe button, hit the like button, and I'll see you in the next video.